Hello everyone, today I'll explain why I sold all my stocks and moved to bonds. Due to the COVID virus, many businesses and workers had to limit contacts to protect their health. Consequently, businesses, especially those dependent on direct customer interactions, suffered unexpected blows, forcing many to cease operations and others to adapt to survive. This resulted in job losses and decreased company revenues. With fewer people employed or operating businesses, there was a decline in purchasing power, affecting the ability of certain companies to sell their products. All of this eventually led to the crash of the stock market in 2020. To salvage the situation, the Federal Reserve began printing and distributing money to help people and businesses. Additionally, it decreased interest rates to nearly 0% annually. If you don't understand, this means that money became more accessible, as companies and individuals could borrow at nearly 0% interest. This, in turn, means that companies can take easy money and invest it in their businesses to increase profits, while people receive money to buy the same products from manufacturers. This is a standard reaction by the government to save the economy, but it has its downsides, one of the main ones being inflation. After the Fed started printing money, thereby increasing the total number of existing dollars, it led to unbacked money in the economy because the US dollar is a global currency that directly depends on a country's economy. When there are more dollars, it does not increase the number of products you can buy with them, leading to inflation. I will try to explain it on the following example. Think of a small country that only has one car available for purchase, and the total currency for this country is $10. This car can only be bought for $10, meaning that for each dollar, you can buy 10% of the car. If I decide to print another $10, the total amount of dollars will be 20, but the country still has only one car available for purchase. Why doesn't the car still cost $10 as before? Well, imagine someone bought the car for $10, and there is no second car available. What will the person do with the other $10? Right, there's no use for them if they can't buy anything, so the car will now cost $20 instead of $10. This means that the currency has doubled when the number of goods has not increased, leading to inflation. In our situation, take a look at asset prices, especially the S&P 500 index, after the crisis. Doesn't this remind you of the country example I mentioned earlier with one car? Do you think the number of goods increases if people just receive money from the government that they can use to buy what they want? Certainly not. To survive, businesses start raising the prices of their products due to inflation. This, in turn, leads to people buying less in stores because nobody increased their salaries. Therefore, now they need higher salaries. And if you do increase salaries, it leads to products sold abroad becoming less attractive because they don't have a machine to print dollars, they have them in a limited quantity. If the costs of producing products abroad increase, the final price of the product will also be higher. This already leads to other countries looking for cheaper alternatives if they exist, and if they are found, the exporter loses income. The list can go on indefinitely, the essence is the same, it leads to a depression. To avoid this, the Federal Reserve is using its main instrument, which is raising the interest rate. This action has the complete opposite effect of what I described earlier. Money becomes less accessible due to high interest loans. This makes people spend less, leading to companies spending less on expanding their business because there's no one to buy their products. To get them to sell, companies make their products more accessible or lower the prices. To survive, they start laying off employees, which leads to people buying even less, and it's very difficult to find a balance between these two decisions, raising or lowering the interest rate, as each decision leads to its catastrophic consequences for the economy. But now, let me return to the theme of my video. Today, I want to explain why I sold all my stocks and moved into bonds. If you've been listening carefully, you should understand what I'm about to say. Right now, the interest rate is high like never before, yet stock prices continue to rise, which isn't normal because stocks directly reflect the performance and successes of the companies they are tied to. During times of such high interest rates, it's incredibly challenging for companies to increase their income. Just look at the companies that have failed to satisfy their shareholders. That's very alarming. You must also understand that the S&P 500 index is almost 30% comprised of 10 companies. Some of them are now valued in trillions of dollars. Look at the market capitalization of some of them, which has become more than $1 trillion higher in these 3 years. Yes, trillions of dollars. Have these companies started producing more in line with their capitalization? The P/E ratio indicates they haven't. Moreover, have you seen the oil prices? They are currently at a very high level. Do you know what that means? It means that logistics, production, and other sectors directly related to the production of these companies have to consider this price to survive. All the major players are starting to sell stocks because they want to preserve their assets. Also, remember, when someone sells a stock, there's someone else on the other side buying them. You should ask yourself, why did I buy stocks from this person selling them? If all the major players, who hold most of the money, are selling assets, who do you think is buying them? If it's really you, then I hope you'll reconsider after this video whether you should continue. Additionally, some banks, due to the policy of increasing interest rates, were supposed to declare bankruptcy because if they bought bonds for 5 years at 3% annual interest, and after 1 year, the interest rate is already 5%, people who invested in these banks will want to withdraw their money to get higher returns. The bank can't return the investments because bonds have a maturity date, and this led to bankruptcy. And remember, one's expenses are another's incomes. If banks lose money and start reducing their expenses, someone isn't getting their income, and the cycle continues indefinitely. So, what do we have here? High interest rates that will eventually lead to asset revaluation. High prices of essential resources, coal, gasoline, oil, that negatively impact the final product price. Sell-offs by major investors, indicating their shift to safer assets like bonds/gold. And if there's no investment in business, the economy can't grow, and these safe assets are certainly not an investment in the economy. Job layoffs and increased unemployment due to the aforementioned factors, as businesses need to survive, and they don't have money to pay unnecessary personnel. This leads to reduced consumer spending, which negatively affects stocks. Elections, in my opinion, if you want to sell assets, you should do it before the US elections. Look at the stock market history, it's never been in a loss before elections, it always drops afterward. I'll give you an example with Bitcoin. When its price was falling, all the news advised selling to further lower the price and profit from people. But when Bitcoin was rising, the same people said it would reach $100,000 to increase the price and sell it at good rates. Even I, someone not interested in Bitcoin, received this information, but now there's silence. Now, sit and think, Bitcoin's price has almost doubled, and there's no talk of $100,000. It's either they have nothing to say or someone prohibited them from talking about it. Everything I've described above will eventually lead to even giants like Apple, Microsoft, Nvidia, Google, etc., experiencing decreasing revenues. And if this happens, and it probably will, then the already high P/E ratio will become even higher. Do you think stock prices will be the same as today? No, there will be an asset revaluation because people invest to increase their capital, and if they can double their investments in 50 years, it doesn't seem appealing. Since stocks are risky assets, investments will flow into bonds and other assets. Why did I switch to bonds? The reason is that I buy an ETF on bonds, and as of today, it has an approximate annual yield of 3%. It's not much, but this index is directly dependent on interest rates. If the interest rate decreases, the price of this ETF rises because its yield will exceed the yield of new bonds. Conversely, when the interest rate rises, the price decreases so that the dividend yield can compete with new bonds. And if people start investing in bonds at such high rates, it means that the government will have to pay back these funds with high interest, which will lead to an increase in their already not small debt of $34 trillion. That's why I don't think this can last long. Sooner or later, the Federal Reserve will have to lower interest rates to save the economy, and this will lead to an increase in the price of my ETF. But that's not the only reason why I moved to bonds. Until the day I sold stocks, every month I bought the S&P 500 index, regardless of the price, even when everyone was panicking. I even looked for opportunities to invest more. Consequently, I achieved a decent average price. I decided to sell the assets not only because of what was mentioned earlier but because since childhood, I had a goal to buy property in Europe, and I'm very close to achieving it. I believe that in 2 to 3 years, I'll be able to make it a reality. That's why I sold my assets and moved from an investment phase to accumulation, because I don't know what will happen in 3 years, and I want my money to be safe until I buy real estate. If you invest with a horizon of at least 7 years, your investments will be safe. All you need to do is buy your assets regularly, even if my forecast of asset revaluation comes true. You'll have the opportunity to buy them at good prices, and your average price will be good. But you'll always be in the market, and history shows that the market always returns to its highs and creates new ones. That's why, if you don't have a situation like mine, where I'll need this money in 2 to 3 years and don't want to take risks, you shouldn't sell your assets.